So hi everybody, this is Hub. I'm Giacomo. Today I'm again with the Convequity team. I'm with Jordan Lambert and Simon Hay. Jordan is a CFA chartered, and today they're going to talk about Palo Alto Networks. So please introduce yourselves, and then we'll jump into the presentation of today.
Right, yeah, so my name is Jordan, Managing Director of Convequity. And yeah, Convequity is an equity research firm. We cover most of enterprise software type of stocks. We like to target stocks that are high growth and have a high potential of establishing a solid moat. And we like to try and knock down the barriers that investors often face when they're trying to understand technology stocks and understand the investment potential. So trying to blend that kind of financial and technological know-how together. Simon, do you want to briefly introduce yourself?
Yeah, so I was the online forum manager for kind of covering the consumer electronics, and then gradually moved to kind of cover the enterprise technology. And I took my undergrad in finance. So I found that it is very alpha rich to combine the know-how in technology with the financial understanding. So that's the value addedness that we can bring in to the investment research.
Great. So here we are today to present the investment thesis for Palo Alto Networks. Here's a quick disclaimer for viewers to pause and have a read of. The general gist, though, is that this is not investment advice. Some discussion points. We're going to discuss the cybersecurity landscape and its catalysts, what Palo Alto Network does in the cybersecurity industry. We're going to discuss Palo Alto Network's relative attractiveness from an investment perspective, the business strategy, some financial analysis, and finally, we're going to touch on the sentiment and the valuation. Here's a quick overview. Palo Alto Networks operates in cybersecurity software. They were founded in 2005. The markets that they serve are network security, cloud security, endpoint security, and operations. So the endpoint security is basically detecting and eliminating threats on users' devices as well as servers. Revenue for Palo Alto Networks has surpassed 4 billion. It actually will probably be approaching 6 billion by the end of fiscal year 2022. And because of the pandemic, revenue growth has accelerated, as we'll explain. Current price is, well, it's around $600. This is slightly out of date, so it's just viewers should check that. But our estimated intrinsic value range is $950 and above. This is probably the most important slide, so I'm just going to spend a little bit of time on this slide. Cybersecurity is a very large industry worth tens of billions of dollars, and it's still growing between 10 and 20% each year, and is expected to do so for the next few years. So there's not many other industries with that size and growth. So there's a lot of opportunity for investors. The main catalysts driving the industry are these around this circle here. So we'll just begin with the distributed workforce. So viewers will be aware that the pandemic forced distributed workforces onto organizations. Before the pandemic, there were trends of workers becoming more and more remote, not having to go into the office as much. But there was only a few percent of the workforce working remotely. And at that time, a corporation's network could be described by a castle and moat. So you have a castle where you have everything inside, like the branch offices, the main office, the data center. Everything would be inside the castle. And then you'd have a moat surrounding it, the perimeter. And on the perimeter, you'd have firewalls. And these firewalls would check all inbound and outbound connections, looking for threats and protecting the organization by either allowing access or denying access. So this was working quite well, and any remote workers who was outside of that castle and moat would connect to the corporate network via a VPN, be checked by the firewall, and then access whatever they was looking to access inside the castle. But when the pandemic came along and forced the lockdowns and everybody had to work remotely, that just completely obliterated that castle and moat concept. And pretty much every member of the workforce was working outside the castle and moat. Everybody was working remotely. And it caused quite a lot of problems, because now everybody who was working remotely had to use a VPN to connect into the corporate network. But at the same time, organizations had to adjust, and they had to use more cloud resources. So more apps were appearing in the cloud. So if you're a remote worker and you need to access an application, not just in your company's private data center, but also in a public cloud, then what was happening was they'd connect with a VPN into the castle and moat, into the corporate network, be checked by the firewall, and then be rerouted back out to the app in the cloud. And obviously that creates a lot of latency, and there's a lot of bottlenecks in the traffic, and just it generally caused a poor user experience. So there was a lot of opportunity for cybersecurity companies to add value here and solve problems. One, by offering direct access, so remote workers could directly access the apps that they wanted without having to go into the corporate network and be backhauled out somewhere else. And secondly, they could deliver better security, because doing that just wasn't a very secure way of running an operation for a corporation. And then we have IT sprawl, which was a result of companies having to use more cloud IT infrastructure in order to sustain and maintain user productivity, the productivity of their workforce, but also to generate more applications in order to satisfy consumer demand, because everything went online. So before the pandemic, pretty much everybody, all of companies' IT infrastructure was inside the castle, inside the data center. But because of the pandemic, companies now have some IT assets in the data center, but also some assets in the cloud, maybe some edge deployments where they're operating some Internet of Things devices. So generally, there's more of the IT sprawl for organizations post-pandemic. We've also got rampant developer activity, which is a result of when the pandemic came, it kind of removed in-person interaction. So it removed that in-person interaction between consumers and businesses. So therefore, consumers demanded a better online experience. And in order to meet that demand, developers at various enterprises were forced to increase the pace at which they can produce better applications, and they was using more cloud infrastructure to do that. But to help these developers, there's some clever software firms that was allowing developers to automate with certain tools, so they could automate infrastructure in the cloud in order to speed up the process of provisioning and then developing applications. And typically developers don't have a security first mindset. So this has caused quite a few problems, and it's the result of a lot of breaches that have occurred, data breaches that have occurred in the cloud. So yeah, I won't go into too much detail in the other ones, but we've got greater connectivity has caused an explosion of more data, and also using cloud infrastructure means that, well, kind of before the cloud, an application could be hosted on one server, but now applications have been broke up into smaller components, hosted in various areas of the cloud, and that it's just generating more data because each component of an application generates its own data. So there's been an explosion of data, and also an explosion of data because of 5G, Internet of Things. Everybody has more than one device nowadays. It's quite concerning the amount of sophisticated attacks that are occurring right now as well, and that is just going to get worse with Russia's retaliations because of the sanctions that have been placed on them because of the Russia-Ukraine war. We've got a severe cybersecurity talent shortage. There's around 3.5 million jobs globally that need to be filled. In America, it's around 500,000. So there's a big shortage of talent. And the seventh main catalyst is the industry's own technical debt, because in the last 30-something years, we've gone from firewalls to signature-based antivirus solutions, and then more people got connected online because of the popularity of the internet. And then we had the era of mobile, where people were using their mobile to connect online more, and then using mobile devices to do more work. And then companies are using more cloud infrastructure, and then we have the distributed workforces. And every time there's been a major dynamic change in the industry, there needs to be new security point solutions in order to solve these problems. And now we have a situation where organizations just have probably anything between 50 and 100 different security point solutions all cobbled together to try and secure their organization. But ironically, the more point solutions you add, the more it actually weakens an organization's security posture, which so that needs to be addressed as well. Simon, do you want to add anything? Maybe just mention the needs here, like how
I think just think about the demand and the supply. The demand for cybersecurity solutions cannot be even stronger after the pandemic because of the remote work and the subsequent increase in the nation state level cyber attacks. And it's also because people are shifting to the more modern digital infrastructure. So they are moving away from the traditional way of running their infrastructure. And that means a change in the way the data are processed and the way how we communicate with each other. So that requires a new set of tools to protect new digital assets. And then think about the supply. Typically we need a more automated solutions, and we need a more effective protection to deliver better results. And this supply landscape also requires a more comprehensive, best of the breed vendor to tackle that. So we will discuss it further down the slides.
Right, and just lastly, so the reason we're mentioning all this, because all these catalysts are driving the industry, the main catalyst driving the industry, and weakening the security posture of organizations, giving attackers, bad actors, more opportunity to exploit gaps in an organization's security defenses. And it's creating all these security solution needs inside the circle. So you've got zero trust, which kind of addresses allowing remote workers direct access to apps securely. You've got the intelligent networking, which is needed because of the distributed environments, remote workers are connecting to things in different places, and you need an intelligent networking software in order to make sure the organization stays productive and the workers have a good user experience. The autonomous software is very, very important nowadays because mainly because of the severe talent shortage, right? Because if you've got a small security team at an organization and they're having to manage up to 100 different point solutions, that is very time consuming. So any software that can take off much of the legwork and do a lot of the menial tasks is very, very important. You've got shift left security, which is related to securing developers' activity, the data-centric security, and then you've got the vendor consolidation, which kind of addresses a lot of these issues, but also an organization's technical debt, which is associated with the number of different point solutions they have. So Palo Alto Networks, it can provide each one of these solutions, and not just an average solution, you know, a best of breed solution. So this is why we think Palo Alto Networks is the best positioned company to prosper during this landscape over the next 5 to 10 years. This is a very fragmented and complicated look at the cybersecurity landscape. It's not supposed to, viewers aren't supposed to actually be able to see the detail. If you want to see the detail, literally just type in Optiv cybersecurity technology map into Google and you'll be able to see it in more detail. But this is just to highlight that the industry is very fragmented, and there's a lot of startups and established players in various niche areas within the landscape. And this is probably puts off a lot of investors for getting to know cybersecurity stocks, but at the same time, it offers a lot of opportunity for investors to gain an information edge. However, we've just attempted to simplify the landscape you've just seen before. So this diagram pretty much covers the entire security industry. Each colored area is a high growth part of the industry. So we'll briefly just talk about this. We've got the north-south blue label there. So that is securing any employee connection that an employee that might be remote at the branch or at the head offices that wants to connect to the internet or connect to a private data center inside that castle and moat that we've talked about, or directly to an application that might be hosted in the cloud like AWS. You have the east-west security considerations, because no matter how good an organization's security defenses are, inevitably bad actors are going to get behind those defenses. And it's all about what can an organization do to make it more difficult for these bad actors to move laterally east-west within the organization. So there's various security solutions for that as well. We have cloud security, which is all about securing a lot of what the developers are doing in the cloud and securing infrastructure and making sure data hosted in the cloud is secure. We have endpoint security, which is about detecting and eliminating threats on devices and also on servers. And also we have protecting internet-facing assets, which is all about making sure an organization is minimizing their attack surface. They've not got, say, any improperly configured or decommissioned piece of network gear that's out there that maybe a bad actor could scan, identify, and then try and exploit as a way into the organization's network. So these five colored labeled areas pretty much covers the entire cybersecurity industry that you just saw on the previous slide. And Palo Alto Networks is a leader in each one of these colored areas. Simon, you just jump in, Simon, whenever you want to say something.
Yeah, maybe we can move on to the next slide and I can do the comment.
Okay. This is the same diagram you've just seen. The only difference is we've added some solutions onto these areas, just in case any viewers are familiar with the cybersecurity industry. So, for instance, ZTNA stands for Zero Trust Network Access. That secures connections into the private data center. So yeah, we won't discuss any more of this, but if anybody is familiar, they can kind of combine the solutions with the security areas.
Yeah, maybe I just comment on that. It's pretty funny because can you go back to the previous slide, Jordan?
Oh, right, yeah.
Yeah, one interesting fact is that it's pretty hard to sell into the replacement deals, it's very hard to convince existing users to switch to another new solution provided by one startup or one challenger. So it's pretty typical for us to see that cybersecurity vendors tend to create new acronyms like Zero Trust, Network Access, Secure Web Gateway, and so many acronyms that a layman would find it very hard to understand. But in essence, I think there are broadly two categories. One is the new product to the existing solutions, and the second is the new product to the new solutions. So the first category is about how can we figure out new ways to deliver the security to the existing technology stacks, like your private data center, your endpoint devices. And the second category is about as the infrastructure is innovating, like AWS from Amazon is continuing to introduce new cloud infrastructure solutions. How can you better protect these new solutions? So I think that's what makes the cybersecurity landscape so dynamic here.
Yeah, absolutely. So what does Palo Alto Networks do within the cybersecurity industry? The answer to that is pretty much everything. If you check Palo Alto Networks investor presentation, you'll see that they present their business with three platforms: the network security platform, the cloud security platform, and the security operations. And what we've done here is simply just taken the labels from the previous diagram and slotted them into each of these platforms. So network security covers the north and south connections, and also covers the east and west connections, mainly with firewalls. So firewalls, as I mentioned earlier, used to secure just the perimeter of the castle and moat, but now because of abstraction, firewalls don't actually need to just be in a physical box. They can be in a virtual machine form. So there's a lot more flexibility in deploying firewalls nowadays. We've got cloud security, which includes obviously cloud security and also east-west movement. We've got security operations, which includes the endpoint security and also protecting internet-facing assets and making sure there's no improperly configured network gear out there that an attacker could exploit. So it would be easy to assume that if Palo Alto Networks has spread itself like this and got such a comprehensive scope within the cybersecurity industry, that there might be a jack of all trades, master of none. But this is actually the opposite. They're not a jack of all trades, master of none. They not only do they have the breadth, they also have the best of breed solutions within each area of security. So this slide is actually old now. They're a leader in about 9 different categories. So it just shows you how their execution is pretty good. They're not just going with breadth, but also going with best of breed solutions.
Yeah, and I would just stress that this is a very rare one, because typically for a cybersecurity vendor to thrive, you have to focus on just one or two areas, and because there are so many ways a potential attacker can get into your way. So you have to be focusing on one niche area and kind of figure out all the potential things that you can improve. And that's what we typically see for other cybersecurity companies like Zscaler, CrowdStrike, and many others. But what was very special about Palo Alto Networks is that they are able to be not only strong in their original place, which is next generation firewall, but in the recent 4 years, they have been able to expand into a new categories very fast, and then take the leadership as the best of breed vendor in each of these spaces. So I think it's very special one, and it's a very rare one in the sense that nowadays people are not only satisfied with buying point solutions, they also want to just simplify the procurement process. They want to buy one platform vendor, and Palo Alto Networks offers the best of all worlds. It is able to offer you a comprehensive platform while not losing the kind of the focus over refining the product and delivering the best product out of the competitors.
Yeah, and we'll try and touch on that as to how they actually did this, how they're managing this strategy of being the best in a broad area within the next few slides. So let's just discuss Palo Alto Networks' relative attractiveness. A quick back of the envelope way to do this is simply add up the market caps of Checkpoint Software, Zscaler, and CrowdStrike, and compare that to the total of Palo Alto Networks market cap. So as you can see here that the total, we did this on the 10th of April, but I did check last night and the market caps have all gone down slightly, only by a couple of billion. So it's relatively, proportionally, there's still a lot of value there. So the reason we're doing this is because Checkpoint's business is mainly network security. Zscaler's business is mainly something called a Secure Access Service Edge. And most of CrowdStrike's business is cloud security and XDR. And XDR is a term for endpoint security. And most of Palo Alto Networks business is all three of these categories. So that's why it's quite a good comparison. So if one can say that Checkpoint, Zscaler, and CrowdStrike are at least fairly valued right now, then the upside for Palo Alto Networks looks to be about 70% from here, or 1.7x. However, you may look at this and think, well, there might be disparities with the revenue, or there might be disparities with the free cash flow. Maybe Palo Alto Networks revenue is a lot lower than the aggregate of these three other companies. So let's just have a look at that. So we dive into this valuation a little bit more. We've got Checkpoint, Zscaler, and CrowdStrike. You can see the circles here. So the circles show the total revenue of CrowdStrike, Zscaler, and Checkpoint. And you can see that it's in the same ballpark as Palo Alto Networks revenue. So the total for the three peer stock group is about $4.5 billion, and for Palo Alto Networks about 4.8 billion. So the revenues are in a similar ballpark. However, if you take a look at the other circle on the far right column, you'll see that the price to sales ratio divided by the next 12 months growth estimate is quite different between the two. So the Checkpoint, Zscaler, and CrowdStrike is 1.52, and Palo Alto Networks is 0.52. So that just shows there's a relative attractiveness on a forward basis for Palo Alto Networks against these three companies. And also, oh, sorry, Sam. Yeah, go ahead.
Yeah, and it's not only about the numbers. We also have to think about the fundamentals. Like Palo Alto Networks compete against Checkpoint, compete against Zscaler, CrowdStrike, and we also have to think about, do they offer better products and services? And for the network security, it's very clear to all of us that Palo Alto Networks lead these Checkpoint by a huge margin. So it's almost clear that Palo Alto Networks network security business unit is worth more than Checkpoints. And then move on to the SASE. SASE is more about network security delivered from the cloud. So think about Checkpoint is the network security delivered from your premise, and the SASE is the network security delivered from the cloud. And we believe that Palo Alto Networks, these Zscaler slightly in the sense that they have a more modern solution because they have just created the new product 4 years ago, while Zscaler got started more than 1 decade ago. And Palo Alto Networks, their infrastructure, in our opinion, is more superior than Zscaler. So we believe that in the future, Palo Alto Networks has a huge potential to beat Zscaler in the cloud delivered network security as well. And then move on to the security for the cloud and the kind of the protecting your endpoint devices. This is an area where Palo Alto Networks is just executing its growth strategy. And from the product perspective, we are seeing Palo Alto Networks to deliver way better product compared to CrowdStrike in the sense that it is more automated, is offering way higher effectiveness in terms of doing the protection, but also helping the security engineers to figure out what's going on and what's going wrong within your network. And so there is tons of upside potential. And at the same time, maybe investors are just finding it very hard to understand Palo Alto Networks because it's offering so many products. And many people may be suspecting that it's losing a bit of focus. But our finding is pretty contrarian in the sense that Palo Alto Networks is not only thriving in all of these areas, but it's actually leading each category's leader as well.
So this is sum of parts relative valuation, but using free cash flow, because at the end of the day, cash is king. So again, we've just added up the totals of Checkpoint, Zscaler, and CrowdStrike's total free cash flow and compared it to Palo Alto Networks. So we can see the total of the group is 1.8 billion. It's in the same ballpark as Palo Alto Networks free cash flow for the trailing 12-month period, which is 1.5 billion. And then if you take the price to free cash flow multiple and then divide it by next 12 months growth estimate, you'll see a big disparity like you did in the previous slide with the price to sales ratio. The difference isn't as big, but you can see that Palo Alto Networks at 1.66 is a lot more attractive than this peer group at 3.66. So again, we think a lot of relative attractiveness in Palo Alto Networks. So we're just going to discuss the business strategy for Palo Alto Networks. The major turning point in Palo Alto Networks business occurred when Nikesh Arora became CEO in July of 2018. Arora decided to utilize Palo Alto's high cash flows from network security division to buy best-of-breed startups for building a best-in-class cloud security and security operations platform. He considered this aggressive M&A necessary given Wall Street's outlook for Palo Alto. So on the right-hand side of this slide, you'll see an assessment by Credit Suisse back in September of 2017, assessing Checkpoint, Palo Alto Networks, and Fortinet, assessing their prospects as we enter deeper into the era of cloud. And you can see that Credit Suisse actually believed that Checkpoint was better positioned to prosper in the changing dynamics of the industry as it relates to the cloud. And it wasn't too positive on Palo Alto Networks and Fortinet. And this is quite interesting actually, because it's turned out the absolute opposite. So Checkpoint, you might be able to grab this from the previous slide. Checkpoint's revenue from the cloud is probably in the single digits of total revenue. And Palo Alto Networks and Fortinet's cloud revenue as a percentage of total revenue is a lot higher. It's a big chunk. So it just shows you how successful Palo Alto Networks and Fortinet has been in transitioning to the cloud. But back in 2017, this wasn't the general perception by investors. Credit Suisse and many other investment banks for Palo Alto Networks was really going to struggle. And they would have if it wasn't for Nikesh Arora, who came in and just thought, right, we've not got time to build all of these new solutions that we need to thrive in the cloud. We need to have a smart strategy, and now we can go out and acquire what we need to acquire, but use our first principles understanding of security that was developed in network security in order to leverage that and stitch it all together. So in 2.5 years, Aurora made 9 acquisitions to build these platforms, spending $2.5 billion. Oftentimes, such aggressive M&A leads to shareholder value destruction. However, Aurora has given an unusual amount of empowerment to the acquired founders, resulting in many of these founders staying at Palo Alto to drive and execute their vision. We surmise that part of the thinking behind a risky strategy is that Palo Alto could leverage its first principles understanding about security to make these acquisitions fruitful. And furthermore, the idea was to leverage Palo Alto's highly successful sales and marketing operation that had been a key component for them becoming the market leader in network security.
Yeah, and I think one key thesis for investing in Palo Alto Networks is really about Aurora. So he is a very one-of-a-kind special business executive in Silicon Valley, because he was the chief business officer of Google, kind of helped Google out of doing the monetization of its hugely successful search, YouTube, and various other businesses. And then he moved on to be the second chief in control for the SoftBank. And he had so many successful investments, kind of the venture capital stage, early stage investment for SoftBank. And I think he's a very smart investor as well, because he was the one who rejected the WeWork deal that eventually troubled SoftBank a lot. And he disagreed with the SoftBank's founder, Masayoshi Son, and then he left the company, and then he joined Palo Alto Networks. So he is he has a nice blend of kind of the investor judgment in choosing which startup to buy, and then he also has the operational know-how, how can we drive and deliver better value to these acquired startups. So he is able to leverage the existing sales and marketing operations from Palo Alto to empower these acquired startups to sell into more enterprise customers and help them grow. So that's where you have tremendous amount of synergy. So I view it as kind of the Berkshire Hathaway of cybersecurity, in the sense that you can continuously compound your previous success and acquire smaller startups and help them achieve more and then deliver greater value in the future.
Yeah, I would just kind of echo and add a bit of color to that, Simon. Yeah, so Aurora, he's basically took his experiences, as you mentioned, at Google and then SoftBank, and applied it to Palo Alto Networks. So Google was generating high amounts of cash flow with their ads business, and they use that cash flow to make opportunistic acquisitions of various startups. So that is one benefit of having one side of your business high cash flow, and then also being innovative as well, because you can look for opportunities to invest that cash flow. And then he joined SoftBank, and again, SoftBank is generating high cash flow from its telecom business, and using that cash flow to be opportunistic in making acquisitions. So he had a lot of experience in seeing businesses operate like that. So then when he got the opportunity to become Palo Alto Networks CEO, he must have been licking his lips, because, you know, he thought, right, I know how to turn this around for Palo Alto Networks. We've got a network security business that is very high cash flow, very profitable side of the business. If they're going to survive in the new era of the cloud and the changing industry, then he wants to come in and use them cash flows from the network security business to make these key acquisitions. And it's quite unbelievable that, well, we'll see in the next slide, that he's totally turned it around for the company and opened a lot of doors of growth, which wouldn't have been there if he hadn't made these acquisitions. So Aurora spent 2.5 billion on M&A from October 2018 through to February 2021 on these platforms referred to as next-gen security. We estimate that if Palo Alto paid an average price to sales ratio of 25 times, then the collective revenue from these 9 startups would have been 100 million at the time of the acquisitions. And we estimate, well, don't estimate, it's actually been disclosed that next-gen security has already reached 1.4 billion in annual recurring revenue. This division is growing at about 70%, and probably will generate an average CAGR, compounded average growth rate of 50% over the next 5 years. So we surmise that Aurora could have paid back this 2.5 billion of investment in another 4 to 7 years. So yes, the plan appears to be working very well. Moving on to some financial analysis. Growth has accelerated in 2021 as a result of the pandemic, because of those catalysts we highlighted, and Aurora's moves and Palo Alto Networks being having best of breed solutions in each of these areas. Gross margin has been slipping slowly, possibly due to a number of reasons, like the product and software as a service revenue mix. More and more businesses kind of shifting over to the cloud rather than business from physical appliance firewalls. And also there's amortization of intangibles as a result of the M&A. But this is expected to stabilize and even reverse. When the sales and marketing, R&D and stock-based compensation normalize during the mature stage, we think that the operating margin will reach a minimum of 20% and the free cash flow margin will reach a terminal value of 45%. So long term, at the moment, it's not a GAAP profitable business, but in the long term, if you take a look at the current free cash flow margin, and when costs normalize, you can envisage that it's going to be a very profitable business.
Yeah, it's just a very growthy business, and the management is focusing on the cash flow generation and kind of use these cash flow to grow the business. So we are not too concerned about it making a GAAP loss. Yeah,
I mean, an interesting way to see, okay, how, because what puts off a lot of investors for Palo Alto is, yeah, it was founded in 2005 and they're still not GAAP profitable. And I totally get that. But the alternative is kind of what Checkpoint Software have done. And they've been quite profitable from the early days, despite there being lots and lots of opportunity in cybersecurity. They've not invested in order to open new doors of growth. And Checkpoint Software now, bear in mind, there was head-to-head with Palo Alto Networks at one point. Now their growth is just in the low single digits because they've decided not to invest and just focus on reducing costs and maintaining profit, which is the wrong move, really, in an industry like cybersecurity, as we've already outlined. It's very dynamic. It's always going to be dynamic because it's got an adversarial nature. These security software firms are trying to protect organizations against bad guys. So it's always going to be very dynamic and lots of opportunity. So it makes sense to invest for growth, and that's what Palo Alto Networks has done. But if you want to figure, right, okay, well, what is the long-term profitability profile of Palo Alto Networks? Maybe just take a look at Checkpoint Software right now, because they do have very high profitability, operating margins around 40%, free cash flow margin is higher than 50%, net margin it must be around 30% if I recall correctly. So, but you could use Checkpoint Software right now as a terminal profile for Palo Alto Networks in maybe 5 or 10 years' time. Looking at financial analysis, so revenue per employee. We kind of presented this in our previous Palantir presentation, and we thought we'd add Palo Alto Networks into this as well. Palo Alto Networks revenue per employee is about $420,000 per employee. This is higher than average because Simon and I have done this simple metric quite a few times, and there seems to be a central tendency between $250,000 and $350,000 per employee for software firms. So this is higher than average. I don't know if it could go that much higher into maybe like the bracket of Adobe at $640,000 per employee, mainly because even though we're very bullish on Palo Alto Networks, I don't think any company in the security industry can become really, really dominant, and because it's just so dynamic and there's always new areas popping up, as we depicted in that earlier very, very fragmented diagram of the industry. So it might be difficult for them to leverage this revenue per employee anymore, but it's still impressive to know that they are at a very fundamental level. They do have a lot of leverage in their operations. Just to quickly look at the cash situation, the balance sheet. So there's 3.3 billion of cash and cash equivalents on the balance sheet. Free cash flow is looking very good at 1.5 billion. The M&A spree has calmed down. The last acquisition was in February 2021. We expect there might be the odd future acquisition going forward, but there's not going to be a prolific buying spree like there has in the past. There is some debt in the form of convertible notes, but those are likely to be converted due to the share price being way higher than the conversion thresholds. So in summary, Palo Alto is cash rich and financially solid. Some valuation considerations here. Palo Alto Networks rule of 40, which is in the far right column here, last 12-month revenue growth plus the free cash flow margin, which is a measure of the rule of 40. It's at close to 60%, and that actually puts them in the top 12% of a 104 stock distribution of stocks generating sales above 2 billion. So they have an elite rule of 40 in the top 12% of the distribution. However, their forward free cash flow multiple is in the bottom 10%. It's actually in the bottom 8%. So you can see just by that there's a big mispricing there. They've got an elite rule of 40, but on a forward basis, the free cash flow multiple is in the bottom decile. Something not quite right there. Right, so we've got the DCF valuation model that we'll take a look at. There will be a link for to go in. Sorry, a link in the description to go to the Google Sheets and have a look at this in more detail. But now I'll just switch across. Right, so here we have the DCF valuation for Palo Alto Networks. We like to keep our valuation model very simple and just focus on revenue growth and free cash flow margin, because they are ultimately the key determinants, and also stock-based compensation as well. So we've got historical revenue and revenue growth. We can see that in the pandemic, revenue growth accelerated, and at the end of fiscal year 2022, we expect it to be 28%. Well, that's according to the guidance from management. Yeah, we'll let viewers kind of click the link in the description and take a close look at this. But we essentially, with the explicit forecast period goes out to 15.5 years. So that's the amount of time that we've scaled the revenue growth from the current kind of 28% down to the sustainable growth rate of 3%. And you can see here, adding up all the present values of the free cash flows and then the present value of the terminal value, we have an enterprise value of $107 billion. And down below, it's just for reconciliation items from enterprise value to get the equity value. So you can see the current price is about 578 right now. So it's dipped quite a lot since we first put together this presentation, because in the opening slides, we put it was $610. So it's dipped from there. But our intrinsic value per share is about 960. So yeah, this is including, let me just check. Yeah, including stock-based compensation. So yeah, it's around $960. So we believe there's a substantial amount of upside, and we really think these parameters are quite conservative. What's your thoughts, Simon?
Yeah, I think it's fairly conservative, and it just shows you how much potential out there is for Palo Alto Networks.
Yeah, great. Right, sentiment. So the breadth, we've been thinking, why is Palo Alto Networks mispriced by investors? We think that partly it's the complexity of the industry, and with Palo Alto Networks covering it so much of that industry, inevitably there's a lot of breadth and complexity in Palo Alto's business. So hopefully we've helped investors better understand Palo Alto Networks in this presentation. We think that the Legacy Hardware Association puts them in a legacy bracket by many investors. You know, you have security companies like Cloudflare and Zscaler and Okta. They've been born in the cloud for the cloud. And so we don't have any kind of attachment to physical boxes that are like firewalls that are doing these security inspections on clients' premises. So they're just kind of, I guess, a bit more cooler. And they are obviously showing high growth, but Palo Alto Networks approaching $5 billion, $6 billion in revenue and still almost growing at 30%. They are actually claiming more market share than these smaller guys like Cloudflare, Zscaler, who are growing, they are growing higher, but it's at a lower revenue base. But yeah, there seems to be an association that Palo Alto Networks is a legacy company, and they're not adapted. But as we've hopefully presented in this thesis, that they have adapted very, very well. So they're not a legacy company anymore. We also think the discount is probably partly attributed to negative GAAP operating margins and net margins. But when the stock-based compensation and sales and marketing expenses normalize as the growth outlook matures, this will be a very GAAP profitable business, as already indicated by the high free cash flow margin. Just a reminder of the growth catalysts here. And generally, the ongoing and increasing digitalization, that is the overarching dynamic, is increasing digitalization. And this necessitates more usage of public cloud infrastructure, which in turn increases the demand for more specialist cloud security vendors. You know, more things getting digitalized means there's more IT sprawl. And if there's more IT sprawl, then that gives bad actors more of an opportunity to look for vulnerabilities and get inside an organization's network. Conclusion, part one. So cybersecurity is always going to be a very dynamic and unique industry because of the adversarial component. So it's always about bad actors are always going to try and get inside an organization's network and steal data. So that's a perfect landscape for security software vendors. And also it's very, very good for smart investors as well. Cybersecurity is a very large and growthy industry. With its platforms, three platforms: network security, cloud security, and endpoint security and operations. Palo Alto is a leader in each security area outlined in the earlier diagram. Palo Alto has the most comprehensive platforms, but it is far from being a jack of all trades, master of none. It is an accredited leader in many established and emerging areas of security. The aggressive M&A strategy doesn't work for most tech giants, but Palo Alto has nurtured a founder empowerment, the infusion of first principles understanding of security, and also leveraged its smart sales and marketing to make these acquisitions high return investments with ample energy. Palo Alto is growthy, and its financials indicate it will be a profitable business when expenses normalize during the more mature stage of the business. The stock is considerably mispriced versus other security players. It has an elite rule of 40, but the stock is in the lower ends of the distribution when it comes to valuation. Possibly a possible reason for the mispricing of the cybersecurity industry being complex and Palo Alto doing such a broad array of solutions also makes it a complicated company to understand. The gap losses will no doubt put investors off, and we also agree that if growth declines, or when it does decline to 20%, then Palo Alto needs to accelerate the path to gap profitability. As pointed out, there are lots of secular tailwinds to drive Palo Alto Networks business forward, but the overarching trend is that of digitalization, which is leading to more data and more IT sprawl, all of which need securing. Any final comments, Simon?
Yeah, I just would say that Palo Alto Networks is overall a less well-known sector leader in the cybersecurity space, and we believe that it will continue to grow in the space because it has so strong products, it has very strong sales and marketing, and it has a very strong CEO who is able to bring in lots of talent to build up the business and really just to grow into the longer term. So I think it's a very good opportunity because the business is just so complex. And then if you are able to properly assess the market leadership of Palo Alto Networks and do the kind of forward expectation on how that is worth in the future, and then we can be very clear that Palo Alto Networks has a very good upside potential.
Thank you, Simon. Giacomo, do you have any questions?
Yeah, sure. So my questions are related to the current situation, both in terms of, let's say, the geopolitical spectrum, how that influences this market, but also on the side of higher interest rates, and how that is there a possibility that higher interest rate and a higher interest rate environment could change the strategy from could slow down the shopping spree and maybe have less M&A growth in the future, or not?
Yeah, well, I think the prospect of higher interest rates and the yield curve is flattening out. Actually, the 10-year is lower than the 5-year now. So it is beginning to look like an indicator of a possible recession. So whether interest rates go up or we hit a recession, I think Palo Alto Networks could be impacted, and it could slow down the M&A. But because Palo Alto Networks, like these kind of high growth companies that aren't gap profitable at the moment, they're all going to be affected if interest rates go up. But if we reach a recession, then it could be that like value stocks, if we do go into a recession, all companies are going to lose some growth. So it might be the case that investors chasing poor growth might actually look to Palo Alto Networks and other growth companies, because looking elsewhere outside of a growth sector, they're not really going to find that growth, right? So who knows how it'll pan out if we hit a recession. I think everything's going to fall, but it's like what will fall less or with less magnitude than the others. But if interest rates continue to go higher, I think it would could potentially slow down Palo Alto Networks, but a lot of their finance raising is with convertible notes. So it's quite an effective, cost-effective way to raise finance, just issuing convertible notes with a 5-year timeline, with the hope that their share price is going to be high enough during that time where investors will convert to shares rather than Palo Alto Networks having to pay back the principal. So that has worked so far, and I expect if they need to raise finance and make more acquisitions, they could use convertible notes, which is a much more cost-effective way than just obviously getting a more conventional loan. That answers the question.
Okay.
Well, I just would say financially, they are very solid. They are huge cash flow generative, so they don't have that kind of concern. But if you are talking about the investor liquidity perspective, then yeah, we may see a continued revise down in the valuation. But over the longer term, the demand is over there. And if you think about maybe there is a secular inflation, there is a huge increase in the wage and the various prices, then Palo Alto Networks automation could really deliver higher return over investment because it can replace repetitive labor works. So that should be compelling to a lot of potential customers. And then going into the customer base who are procuring the Palo Alto Networks solution is about the digital transformation. So people are just moving their physical activities online using more and more digital infrastructure. And that means a higher spending over cybersecurity. And in a world of high inflation, I think technology is the only place where we can introduce deflation because we can keep the productivity rising every year. And that should make the tech sector a pretty good place to invest in when the inflation is high as well. But over the shorter term, I think more investors would just be more concerned about the general thing that technology space is generally money losing. So maybe they will sell part of the technology stocks. But over the longer term, if you think about the revenue growth and think about how much cash flow they are able to generate, I don't think that's concerning.
Yeah, actually, I'll just add a little bit of color to 2 points you made there, Simon. There's the automation. So say it does become, we enter a recession and organizations need to make cutbacks. They might need to make cutbacks in their IT department and even their security department. And if they do that, then they would need security software that has more autonomy and automation functions in order to make up for the shortfall in staff. So Palo Alto Networks is a leader in automation and autonomous software. So that could be a big boon for them, even if we hit a recession. And also, if we do hit a recession, then the cutback in spending means that chief information security officers are less likely to be wanting to spend on best of breed point solutions. They'll probably more than likely just go with an existing security vendor. Palo Alto Networks is features in a lot of organizations already. So we'll probably go to an established player like Palo Alto and say, right, okay, we need to, we don't want to buy best of breed, but we just want to expand our scope with you. And so we might benefit from that as well, like a vendor consolidation scenario. So yeah, there's a few ways that, it might be wishful thinking if we did hit a recession and thinking that Palo Alto could prosper, but it is possible because of those factors.
Okay. And another thing that I would like to get a better understanding of is the geographical exposure of the revenue. And yeah, can you give us a little bit of a blueprint on that? And are there some regions where Palo Alto could grow that hasn't grown that much in the past years?
Yeah, it's because Palo Alto Networks it got started with the firewall business, and it's always a price set at premium. So initially, it was very much focused on the US market, especially the Fortune 500, the biggest corporations, most of which are headquartered in the United States. So it has more than 50% of revenue coming out of the US market, and then around 30% out of the EMEA, the Europe, and the Middle East, and lower than 20% coming out of Asia and Latin America, because these emerging markets are more price sensitive. So Palo Alto's product is not suitable for them. But coming into the future, as Palo Alto Networks is kind of switching from being a very pricey next generation firewall vendor into a kind of cloud and the software as a service vendor, the pricing economics is more compelling to less wealthy, less budgeted companies. I think it could diversify a bit for sure.
Okay. And the last question that I have is, you made comparisons before, and one of the companies that you mentioned is Adobe, that does a little bit of different things. But I think that, for example, in that case, Adobe has an advantage given the fact that has so many services, basically does it all, and customers are comfortable going with a single plan with Adobe, like the Creative Cloud, that basically has everything a person could need. Could that be the same for Palo Alto, given the fact that you said it is a jack of all? It is not a jack of all trades and master of none. It does a lot of things. Could that be that network effect, and the fact that does a little bit of everything? Could that be a strategic advantage compared to the other companies in Palo Alto's sector?
Yeah, well,
for sure.
Sorry, I'll just quickly say something. You say go after Simon. Just I was going to touch on the vendor consolidation driver. So there's chief information security officers. They're complaining about the stat that I gave you earlier, that a typical enterprise could have anywhere between 50 and 100 different security point solutions, and managing that is really, really difficult. And managing that many also weakens the security posture, not strengthens it. So they want to have vendor consolidation, reduce that down to a small, more manageable number of vendors and solutions. So Palo Alto Networks is going to be a beneficiary of that. It has been a beneficiary so far as well. But at the same time, you might see some Gartner studies online that shows that these security information officers also want to have the best of breed solutions as well. They may cut back on that if we do enter an economic downturn. But at the moment, they're looking for best of breed solutions as well as wanting vendor consolidation. So as we've outlined, Palo Alto Networks has the breadth, has very, very comprehensive platforms that covers a lot of the security an organization's needs. But within that, they have the best of breed solutions as well, because the Aurora very boldly has gone out there and paid a lot to acquire the best startups in each area, and then infuse Palo Alto Networks' first principle security into that, and empowered the founders to stay on and execute their vision, give them lots more responsibility, and also sprinkle on top the Palo Alto Networks sales and marketing prowess as well to just drive the sales high. So I think we're going to benefit from that need for vendor consolidation and the need for having the best of breed solutions, because best of breed solutions are important as well, because attacks are getting more and more sophisticated. Bad actors are being funded by nation states and other criminal groups, and they're using this funding to automate a lot of the cybercrime, you know, scanning for vulnerabilities across the internet and then executing sophisticated malware. So the attacks are getting more sophisticated, and because of the Russia-Ukraine war, you know, Russia's retaliations to the sanctions, a lot of that retaliation is going to be in cyber warfare. So I think these sophisticated attacks are just going to get more prolific. So having best of breed solutions to fight them rather than your average kind of antivirus solution, which isn't going to stop these attacks, I think is important. And Palo Alto Networks has all of that.
I just would add on Jordan's comment. As you said, you added the kind of the platform comparison to Adobe. And I would just say, when we are thinking about platform, we have to think about what was the synergy. And to me, there isn't too much synergy associated with Adobe's Creative Cloud, because you think about the association between Photoshop and the Premiere Pro. There isn't too much connection. Maybe you could do the photo editing and then send it to Premiere Pro, but there is not tight integration. You can do the photo editing from another app and then send it over to Premiere Pro, but that is pretty different for cybersecurity, because it's very hard to let one solution to be talking with another solution, especially when it is made by another vendor. So this is something called extended detection and response. The idea is that to connect as much information as you can so that you can find every possible attack. So if you are using multiple vendors, it would be a huge headache for you to get every solution connected and then do the analysis all by the same time. So that's the kind of platform synergy for the cybersecurity, which is very different to Adobe. And then we also have to think about the kind of competition perspective. I think Adobe is kind of weak on that front, especially considering we are seeing more cutting edge SaaS companies like Figma competing with Photoshop. But we don't see that from the Palo Alto perspective. In fact, in the leading categories of SaaS markets, I think Palo Alto Networks is really leading the game, even compared to the startups. So this is something pretty special and give us tremendous amount of conviction over its longer term growth.
Okay. So that was a great explanation of the situation. So I'm done with the questions. If you have anything else you want to add, you're free to do so. If not, I really want to thank you for the great contribution and the great research that you have done. So thank you a lot.
Yeah. Thank you. Thank you for having us on again, and hopefully we can do it again in the future.
Yeah, my pleasure.
Yeah, great.
So This is it for today. I'm Giacomo. This is Hustle Hub. See you next time.
Yeah.